a meaningful lift at that. Is it 0.6 or I think, yeah, I mean 0.7 actually, 0.6, 0.7% higher. So that's the part of the market which is right out of the gates jumping up in a meaningful fashion. The mid-cap index will also come up. Look at the market breadth, it's 2:1, more than actually, 2:1 advances to decline ratio. Mid-cap index not very much, right? I mean, it's actually flattish to slightly lower. Nifty's got about 75 points on it. And that's the start. Lots of individual movers with the news flow, which we will get to in just a bit. There is Axis, UPL, IDFC, AU, etc., etc. But that's the Nifty heat map. Quick snapshot view. I think you got about, 11 names in the red and everything else which is up and about. Axis Bank, Adani Enterprises, HDFC Bank and Titan are higher. On the other side, you've got Cipla, ONGC and Infosys, which start in the red at this point in time. Rima.
Well, it's not a runaway rally. It's positive for the benchmark indices. The Nifty is up about 90 odd points, a gain of about 1/3 of a percentage point. First up, with the spotlight on IDFC First Bank, straight away a 10% gash. Stock is now at 75 following the disclosure of the 590 crore of fraud. IDFC First Bank is taking a hit, and AU Small Finance Bank, which has also been impacted. They've been barred from participating in the Haryana government, or they've been dispaneled from it. AU Small Finance Bank has a gain of 5.5%. And the third one is UPL, and that's taking a hit of 7.5%. The company is undergoing a restructuring, but as Nuvama was pointing out, high leverage remains a major overhang. The demerger alone doesn't fix the balance sheet immediately, and the street is giving it a negative bias to begin with. Let's run through some of these IT names. IT was the big casualty last week. And this morning, we've got Infosys opening up in the red. That's got a cut of about 0.5%. HCL Tech TCS, a mild negative bias. The big drag is ONGC, 1.5% lower. Cipla is another one with a fall of more than 1%. Only two Nifty stocks with a cut in excess of 1%. Other stocks in the red include Asian Paints, Coal India, Interglobe Aviation. Crude prices continue to hover around $71 per barrel ahead of the Thursday talks between US and Oman. On the way up, banks are providing support, particularly private sector banks. Axis Bank posts the clarification, not interested, not looking to buy Credit Axis Grameen, 1.5%. That's the top Nifty gainer. HDFC Bank, higher. Shriram Finance, Adani Ports, Hindalco, Tata Motors, Passenger Vehicles, some of the stocks in the grey. Now trying to build up, 125 points up on the Nifty, though the mid-cap index is absolutely flat.
Well, that's right. But there are a few big winners, Rima. The reason that the mid-cap index is underperforming is because a couple of large names, which are not Nifty constituents, they are under pressure. And that's why, in fact, that index appears to be underperforming. But otherwise, there are plenty of winners. Let me run you through a few of them. I'm talking about big 5-10% gainers. D Development Engineers, they have secured a contract worth around 170 crores. If I'm not mistaken, the stock is up close to around 8%. Let's get D Development Engineers up for you on the screen. Morpin Laboratories, that's the other one that we're looking at. 800 crore order win is what they have announced. That's from a global CDMO deal, expanding their manufacturing footprint. That one as well, a big underperformer. That's popped up in trade up close to around 8%. Some of these textile-related plays, since the tariffs could relatively be lower, you have Kitex Garments. Big up movers out there. Nitin Spinners, another stock that's seen a big bump up in trade. Gokuldas, that as well is up and about. Nitin Spinners is the one I'm talking about. So let's get that stock actually up for you. Yes, Gokuldas is up, and Kitex Garments. Cohance Life, there was a large trade of a few hundred crores. That there was a buzz that could get out of the way. That's precisely what's happened. And Cohance, I think, is up close to around 5% because that large block is out of the way. And I think Sri Lotus Developers as well, one of the recent IPOs that corrected a goodish bit from the listing highs. Well, that one as well comes up for you on the screen. That as well is up close to around 5%. But net, the reason that the mid-cap index is underperforming is because some of these large names like IDFC First Bank, UPL, AU Small Finance Bank, they are down between 5 to around 10%. IDFC First Bank because of the fraud in Haryana. UPL because the street is questioning this cooperative action. They were actually expecting some value unlocking to take place, which isn't clear as of now. So that's why the stock has got sold into. And AU Small Finance Bank as well is down in today's trading session. Prashant.
Absolutely. And the news-related names are all lower. At least the three of them that we mentioned are lower. So 127 points is not bad at all at this stage. We have Sanjeev Prasad now joining in. He's Managing Director and Co-Head, Kodak Institutional Equities. Sanjeev, of course, over the last few months has been turning more constructive in terms of the market. He's, of course, joining us from the sidelines of the Chasing Growth 2026 Investor Conference, which kicks off here. So Sanjeev, busy day ahead, busy next few days ahead. And thank you for making time and joining us. Important day as well, because over the weekend, once again, tariffs have been back in the spotlight. And I'm sure you will get that question. How to read this? This 15%, 18%, and you know, how to, if at all, any change to how you would value and what markets should do because of all of this?
No, honestly, it's all very uncertain as of now, given the fact that the tariffs which have been imposed, they are of a temporary nature, 150 days maximum. And what comes after that, we'll have to wait and see. There are several other acts under which the President and the Congress can impose tariffs, and I assume that will be done over the next few months. So I don't think you have seen the last one of this tariff saga anyway, you know. So I don't know whether it is such a material development in the sense, you know, from India perspective, 18% has gone down to 15%. So yes, on paper it looks positive. But the bigger issue is the level of uncertainty over here, you know, for exporters and importers both. I mean, how do they actually, you know, have a strategy in place for the next few months? You know, what tariff should they work with? Which country, let's say an importer like an Amazon, should be importing from? You know, just don't know what is the final, you know, the data point to work with over here. So I guess uncertainty itself is a bigger problem, not so much as the announcements over the weekend.
Yeah. So if you had to take a view in that sense, right? Uncertainty, yes. But if you had to take a view, you'd say eventually there's not very much different. I mean, up positive or negative in that sense, Sanjeev, that's what you would say? Or incrementally, maybe it is a bit more positive, or no, not really?
Yes, on paper, yes, as I said, you know, 18 going down to 15 from India perspective positive. For many other countries, most of them are in the range of 15 to 20 anyway. So I don't know, you know, for example, Japan, South Korea, both are 15. So it doesn't really change much for them. Most of the Southeast Asian countries are 19 to 20. So for them, it's actually a decline. So I don't know whether it is such a material development in that sense. And you know, the bigger issue, as I've been saying, is the uncertainty over here. Because, you know, let's say the goods which are on the way to the US, I mean, what import do you apply? You know, whether it was you built in a certain cost, you know, price based on a certain tariff, and now that's changed midway, you know, when the shipment is en route to the US. So it's, you know, it creates a whole amount of uncertainty with respect to the next few weeks, months, you know, till the dust finally settles down on this saga.
Sanjeev, hi, morning. What's the Kotak view on IDFC First Bank that we've seen the fraud of 590 crore rupees? And every now and then, you know, there are these periodic episodes of fraud. Earlier, it was IndusInd Bank. Now you've got it in IDFC First Bank. So although private banks, I mean, banks in general offer value relative to the market, which is expensive, you keep having these incidents.
I can't make any comments on a general basis, and we don't cover IDFC Bank. So both on the general issue, on the specific issue, IDFC Bank, I really don't have much to say.
Okay, all right. Hi, Sanjeev. Good morning, and good to see you. And as always, Nigel on this side.
Morning.
You know, I wanted to ask you about a couple of aspects, Sanjeev. You know, economic indicators, if I look at cement offtake, power to some extent, you know, cement, steel, rebar pricing, as well as flats, there is some traction on ground, which is giving you hope that the economy is actually in recovery mode and things could look up from here on. Last quarter earnings as well, in comparison to most estimates, were actually better. Will you start getting more constructive on the broader markets? Because there was plenty of froth. Yes, you've made that point quite a few times and well noted as well. And we've seen a big underperformance. Do you think from here on, broader markets can actually outperform going by the ingredients we have in place?
No, you're absolutely correct, Nigel, in the sense that things have started to look better as far as the economy is concerned. Most of the monthly, you know, high-frequency indicators, if you look at, seem to be looking better. If you look at electricity demand, which is a very good indicator, last 2 months in the range of around 5 to 6%, compared to pretty much flattish for most of the current financial year. Cement, steel doing reasonably well. They have been doing well actually for most of this year. Credit growth, most important, that has picked up to almost 15% now. That used to be about 10% in September. And both retail and industry credit growth has picked up, which is definitely a positive sign. And similarly, if you look at other parameters, everything is looking better, I would say, compared to the last few months. So the question now is the sustainability of this. For the simple reason, some of the momentum that you're seeing on the economy is on the back of GST rate cuts, and of course, much looser monetary policy. You have 125 basis points of policy rate cut. So all that has supported some amount of recovery in the economy. How much it sustains, we'll have to wait and see. But at least the next 2-3 quarters are looking better, I would say. Which brings me to the point on earnings. You're right. This quarter earning numbers were better. If you look at Nifty 50 index net profit, that grew about 10%. If you look at the coverage universes, which is more than 300 stocks now, that grew about 15% at the net income level and beat our numbers quite decisively, I would say. About 7% in the case of Nifty 50, even higher, about 6% in the case of the KI coverage universe. So look, things are looking okay. The only question is how long does the momentum sustain? What we definitely need is private sector investment to start picking up, which on the back of job creation can sustain the recovery. On the market part, the challenge still remains the valuation is still very high. So despite the recovery in the economy and the earnings, keep in mind the fact that we're already building in pretty strong earning numbers for the next financial year. So if you look at our own numbers for the Nifty 50 index, we're about 16% plus in terms of growth in the profits of the Nifty 50 index. That's already captured in the next year's valuation, right? When you look at 1 year forward valuations, next year growth is already there. And remember, the market is still about 21 times on a 1 year forward basis, so not exactly cheap. And if you look at parts of the market, especially the consumption bucket, investment bucket, things are still expensive in terms of valuation. So it is imperative we get the earning numbers going for a change compared to what we have seen the last 2 years, particularly FY25, 26. We had huge amount of earning downgrades, and that's the reason why the market did not perform. So on an absolute basis, things are looking better, I would say. Earnings outlook is definitely better, which we have been highlighting the last 4-5 months now. The challenge still remains, as I said, valuations. And the second thing is, if you look at earnings growth in the rest of EM, actually, that's very, very strong. Most countries are actually delivering far higher earning growth compared to India. If you look at, for example, South Korea, if I remember the numbers correctly, some 150% earning growth. Obviously, that's coming on the back of a very strong pricing environment for chips and all that stuff. And the market is at 8p, by the way. So, and you look at across markets, most of them are looking at very, very strong earning numbers this year. Maybe just linked to the AI cycle, but whatever it is, that's what it is. Taiwan is some 40% earning growth this year. So that's what India has to contend with, even though things are looking better on absolute basis. Valuations are high, and the excitement around AI in other markets, valuations are cheaper, earning growth is stronger. So I suspect the foreign interest may still be limited as far as India is concerned.
Sanjeev, what kind of an impact do you expect AI to have on overall markets, not just the IT sector, but in terms of jobs, because that has implications for consumption, real estate, the bottom of the pyramid kind of spending? I mean, at Kotak, have you all done any, or it has positive benefits to productivity coming in through for manufacturing and other sectors. Have you all done any analysis on how the use of AI consumption can actually change India's earnings?
It's early days yet, I would say, and you still need to get your head around a lot of issues over here. But whatever maths we have done, let's start with the immediate impact on the IT services sector and what it means for the broader economy. If you look at the total exports of IT services plus, the software part plus BPO plus GCCs, all put together is somewhere about 6% of GDP. And entire exports is actually value added in a way, barring about 15% of SG&A. Everything else is, in a way, GDP over there. So yes, it is a reasonably large portion of GDP, but do keep in mind the fact that, the impact of AI or the negative impact of AI would play out over a period of time as far as the IT services sector is concerned. Not as if, people are just going to uproot the legacy systems and replace it with some AI-enabled system. I don't think that's going to be the situation over here. So yeah, earnings growth could be, or rather top-line growth would be lower for the IT service compared to whatever people are assuming at one point in time. In terms of impact on the broader economy, If you look at the number of people who are employed in the IT services sector, including the GCs, etc., it's not a very big number, by the way. That's about 7 million, everything put together. That's roughly 1% of India's workforce. And if you look at the average income of a IT worker compared to a non-IT worker, that's about 4x. So that's the impact they're looking on consumption. Some slowdown, I would assume, at the higher end. High-ticket items, discretionary items, I suppose, will see a slowdown. IT services as a proportion GDP is about 6% I would say. And as a percentage of consumption, it's about 8-9%. So keep that in mind, but it's not as tomorrow everything going to zero as the market is, getting worried about. The impact of AI, positive, negative, will all play out over a period of time. Having said that, the impact on the market will be a lot more, faster, which we have seen. The correction will take place in terms of multiples, which we've already seen in case of IT service companies. In terms of consumption, you will see maybe negative impact on consumption through the sentiment route. It's not as if salaries of people are going to go down or, jobs are going to get cut. It's just that people will start getting a little bit more cautious in a slightly more cautious environment. So spending may, in pockets, start to slow down. I will emphasize it's in pockets, not as if the entire economy is going to get hurt or something like that. Over a longer period of time, I would assume AI to be extremely beneficial. Clearly there will be massive productivity gains. Whatever you could do over months and weeks, you will probably do it much faster. What it entails for, jobs on the other side, that we will figure out. But yeah, it's a mind-boggling proposition for sure.
Yeah, and it's a larger conversation, right? This one, because...
Absolutely, yeah.
It's... you can go in so many different directions, but I think, yeah, we need to do that as well. And Sanjeev, I hope the conference throws more light on this, and we'll invite you back for just a conversation on how to think about this, right? Because AI and not just IT services, but the overall consumption impact and other things that it may affect. Thank you for joining us, Sanjeev. Really appreciate it, and thanks for being here.
Thank you, my pleasure.
Okay, all right. Let's just go back to the tariff story, right? So the 15% tariffs now by the US after the setback in the sort of delivered by the Supreme Court for President Trump. Earlier we were at 18, now it's 15, but we were also in the middle for 10 at 10. So it's really all over the place in that sense. Naresh Jalan is Managing Director, Ramakrishna Forgings, and Pallab Banerjee is Managing Director, Group President, Pearl Global. Gentlemen, thanks very much for joining us. Good to have you here. Prashant this side. Pallab, what's the sense? I mean, we are waiting for the executive order, but once the executive order comes and say it is effective as the earlier post said, it will be effective from Monday, right? 3 days. Say whenever it is effective from, for goods which hit US ports, what do you think? I mean, what will the customs, because that is the, in that sense, the proof of the pudding, right? What is the tariff charged when goods hit the US port? What's your sense, Pallab?
Yeah, good morning, Prashant. Yes, as you said, the inconsistency or the unpredictability continues. We have now this ruling due to which they are supposed to get charged only by 15%. We don't know exactly when it starts. We'll get to know tonight as US reopens. So far, Indian goods were tariffed at the rate of 25%, and 18% didn't kick in as yet at the ports. So yes, now it's going to get to 15%.
Yeah. So do you imagine there will be a huge rush of exports? I mean, importers in the US will front load massively. I mean, exports should go through the roof, right? I mean, if, say, for example, from tomorrow, tariffs are 15%, is that something we will see?
No, I don't foresee a huge swing, especially in my sector. See, the benefit that the retailers and the brands will get is most of the other countries were at 20%. So the bulk of import that was happening into USA was at the rate of 20% additional or reciprocal tariff on top of the MFN. Now, with this ruling and then Section 122, which has been invoked by President, it will come down to 15%. So that gives an advantage to all these retailers and the brands by about 5%. So that's a relief for them. And that would mean that they would have a little bit better cash flow. If it had stayed in 10%, that would have been a much better news for them. And for us, the manufacturers, exporters, that means the numbers should get easier. That means the order bulk or the volume that we will be getting for the next seasons, as their cash flow eases off, they can freely buy more. Of course, like it's not that free as of yet. If it had been zero, then back to MFN, that would have been a huge benefit for all the retailers and the brands. Now it's somewhere in between, maybe 15% more towards the high only. That's what it is. At the same time, most of these retailers believed that, first of all, the Supreme Court judgment would not come out so soon. It was a little bit of surprise. And at the same time, they believe that the Trump administration would work out something else to compensate for the earning of tariff that the US government was planning for.
Yeah. So for textile apparels, what is the tariff rate now out of if you send from India to the US, according to you?
For garments, we export most of the cotton goods. Average, I would say, for cotton apparels like T-shirts, shirts, polo shirts and all, those would be coming around average of 15%. So every HSN code has a different MFN tariff. Average would be around 15 or 16%. And on top of it, this Section 122 tariff, which will be another 15%, will get added.
Okay. So sorry.
Earlier it was the MFN plus the reciprocal. Now it is MFN plus the Section 122.
I see. And MFN is how much, Pallab?
MFN, the average, I told you, in terms of cotton garments, it comes out to be about 15 or 16%.
I see. So now it is 15 plus 15 in that sense.
Yeah.
So it goes to 30.
Yeah, and that's for all the countries, not only for India, right, but for every Bangladesh, Vietnam, Indonesia, everybody who is exporting into the US.
But Bangladesh was zero, right, Pallab? If they imported US cotton and then sent garments. So from zero, they go to 15, right?
No, they didn't go to zero as of yet.
Correct.
There was one discussion that if they import the cotton fabric, there will be some kind of duty waiver to 0%, whether it was on the component of the cost that is going into the garment or the full garment. We're not still clear as of yet. It's one of the points in that discussion that is going on. So right, they're still at 19%. So they have been in 20%. They came down to 19%. That's what we were told. Again, the 19 has not been implemented as yet, but that's the discussion.
Right. So they will also be somewhere where we are, around the same level.
Everybody is same. Everybody would be at the same.
Whoever had MFN would be at the same level, basically.
MFN is at the same level. Section 122 at the same level.
I see.
So it's equal playing field for these 150 days for every country.
Right. Mr. Jalan, now let's come to auto, sir. What is the number here, as you see it, for your exports?
Good morning, Prashant. I think right now we fall under auto is falling under Section 232. So I think it's basically 25%. I think the trade deal with India, we were expecting some concession for the auto component parts to move to 0 and 18. I think we will need to wait for fine prints, how it emerges over the week. But right now it is at 25% under Section 232. And non-auto parts, which goes into oil and gas and other engineering parts, they come into 15%.
And you told us that this 25%, which is Section 232, is what percentage of your revenue, sir?
So about 15% of our revenue.
Comes at 25%.
Yes.
And what percentage of your revenues comes under at the 15% rate now?
It is around 5%.
Okay, 5% of your total revenues at 15 and 15% at 25 as of now. Yeah. 232, of course, is got that. Just a quick word, Pallab, just to come back to you. That question, right? Why wouldn't would there be any front loading in any sector at all, or no? Nowhere, as you see it, Pallab? Or it would have happened if the tariff had fallen to 10%?
Yeah, if the delta had been higher, because then it made sense for apparel sector. If you look at it, 18 to 15. It's only 3% difference. Because our commerce minister and the ambassador from US both were saying that within this week, this 18% will get affected. So it's not a major difference for us. I think what I'm looking forward to is, yes, there is an uncertainty, but for the retailers and the brands, it's better cash flow at this point of time. Somewhat better, because for them, a 5% on the global import is significant.
Yeah, yeah. Yeah, got that. And of course, I mean, these deals will have now to be renegotiated, I'm assuming, because the basis of the IPA basis is gone. And it'll have to happen with all countries in that sense. Mr. Jalan, Pallab, I know you have a hard stop, so I'm going to let you go. Thank you for joining us and explaining that. Mr. Jalan, just last word to you, sir. What is anything else, anything additional you're looking forward to in terms of clarity, or it is what it is for now?
No, I think it is as it is I think within next couple of days or weeks, I think the Section 232, how it works out, whether India gets an exemption on auto parts, we will need to look at it. Because of the trade deal said that US auto component exports to US, there will be certain carve-outs for zero duty and to move to 18%. We will need to look at the fine print. But as such, I think that becomes not very significant right now because of the US industry of late in last quarter onwards has started doing extremely well in terms of commercial vehicle market. So I think the pickup is very strong. And I think for this calendar year and the next calendar year, because of the emission norms change, which is happening in next year, I think the front loading is going to happen. And I think we are looking at a good market over next couple of quarters.
Yeah, yeah. Got that. And Mr. Jalan, on refunds, there's no clarity as such, right? And if the refunds have to happen, it'll go to the importers, right?
No, yes, because the customers have already paid us for the duties.
Correct.
So I think we will need to claim the refunds, and as and when the refunds are made to us, we will need to return it back to the customers.
Okay. So it'll have to go back, but I mean, there's no clarity in terms of how that is going to happen, or if that is going to happen. The courts did not weigh in on that.
I think in a couple of days we will need to file for the refunds. But I think as you saw all over the news, I think still I think that there is going to be a legal cases around that. So we'll need to wait for a couple of months before we have a clarity in terms of refunds.
Okay, got that. Thank you very much for joining us, Mr. Jalan. Appreciate your time here, and thanks once again. So that is basically a view from an auto ancillary exporter and a textile exporter as well out of the country. The markets, of course, up 170 points, 25,750 is where we're at. We'll take a quick commercial break here. The management of CleanMax will be with us to talk to us about the issue which is opening. They're coming to the market. Kuldeep Jain of CleanMax on the other side.
Welcome back. Well, the market's holding with solid gains. The reason that the Midcap index is underperforming is because IDFC First Bank, AU Bank, as well as UPL, all three of them are part of the Midcap index. So that's why it's not actually giving you the kind of momentum or the kind of rhythm that we've seen in the markets today. That said, let's focus on the IPO market. Renewable energy major, CleanMax is 3,100 crore rupee IPO. Opens today. The price band comes up for you in the screen in the vicinity of around $1,000 or around 1,053, comprising of a fresh issue of around 1,200 crores and 1,000 OFS of around 1,900 crores. Mr. Kuldeep Jain, the chairman and managing director of CleanMax, joins us in the studio. Hi, Kuldeep. Welcome to the studio and welcome to the stock markets.
Thank you very much.
Let's get a couple of details out of the way. The money that you're raising, that goes back to the company is around 1,200 crores approximately.
That's right.
Majority of it will be used for debt repayment. So first factor, what is the kind of interest savings that will be there, from this 1,200 crore of repayment? And also, how do you fund your future capex plans? Are you comfortable post this repayment if you have a ratio that you're going with?
So two things there. First, if you repay about 1,200 crores of debt and it's about a 9% interest rate, that's about 100 crores of annual interest cost saving, which sort of goes straight to the bottom line. The second thing is, in our business, all renewable energy companies will have debt because you do have assured income from renewable energy sales contracts over, say, 23 years in our case, and therefore you do have a 15, 17-year debt. Our net debt to EBITDA at about 4.6 times is more conservative, lower than industry average of around 5.5 times. So we were, even prior to the IPO, more conservatively levered than renewable energy peers.
Okay.
But we will repay some of that.
Okay, all right.
One question on that, because your borrowing has practically tripled. I think FY23, it was sub 4,000, went up to 8,000 last year. And as of, I think the September quarter, it's more than 10,000. So that's a sharp increase. While I get that your overall leverage is lower than peers at 4.6 times net debt to EBITDA, considering you have expansion plans, what is the leverage going to look like, absolute and even net debt to EBITDA?
We would expect to stay within that conservative, lower than 4.8 or 5x of net debt to EBITDA. But yes, in our business, if our EBITDA has grown in the last 3 years at a CAGR of 58%, year-on-year 58% EBITDA growth, yes, over 23 to now, debt would also increase. Yeah. Okay. Right? As long as your ratios stay the same.
5% is the red line? 5x.
5 times.
5 times
is sort of the red line level.
Okay, all right. A couple of more questions then with regard to your gross margins. Phenomenal improvement. And also on the net profit front, you've turned profitable. Will you continue to maintain these sort of gross margins? I'm not asking you for a forward guidance. I'm just asking you whether or not this band can be maintained. And also the net profit, you continue to remain profitable because as it is, there'll be interest savings. So both those two questions, because at times there's this IPO phenomena that plays out. Please clarify on that.
Yeah, absolutely. So firstly, on net profit, we did make in the first 6 months of this year as much net profit as we had made in all of last year. So of course, that trajectory you can see is continuing. The second thing is from a gross margin perspective, the renewable energy power sales business is incredible. It's like a 94% gross margin. Mm-hmm. And the reason is, I jokingly say that the sun gods and the wind gods, which is Surya Dev and Vayu Dev, do not charge you money for giving you their input, unlike, say, a coal-based power plant or a diesel power plant. So therefore, gross margins are incredibly high, and we do think that is structural unless the government starts taxing solar and wind, which ain't on the cards. It should continue.
Just for a counter question with regard to the industry on the whole, not just your company, what kind of penetration have you all seen, and how big do you think it can go to for a company like yours, in the industry that you operate?
Thank you. So what we do as CleanMax is we make green power, solar and wind, and sell directly to corporate customers. We sell nothing to power distribution companies, which is what most listed utility peers are doing. So what we do is sell to corporate customers, which is also called CNI. So we are the market leader in the CNI space, and being the market leader, we are the first from that space to come with an IPO. And the penetration, so the question becomes how much of corporate power is consumed through these bilateral green sources. It's only about 7%. And a corporate customer whether a chemical company, cement company, or data center saves in excess of 30% at a minimum in any state by going green. So, you save good money for doing the right thing, right?
So,
and therefore, the penetration is rapidly increasing.
So Kuldeep, that's the point. The 30% is the so it's a no-brainer in that sense.
It's a no-brainer.
I mean, right, and we're taking your word for it. It's a no-brainer. I think, but no other. I mean, everything included, all costs considered, everything.
Because in our business model, we make the investment. See, because if you're running a textile company or like our clients are the biggest textile companies like a Wellspun or a UPL or Sona, Comstar, Sansera, and so on. A lot of the listed companies you cover here, they are our clients. We have more than 500 such clients. And this is a new phenomenon. Green power was never cheaper. So 10 years ago, our earlier customers used to be early adopters saying, okay, if it's green, even if it's like, similar costs, I'm happy to shift. But grid power keeps getting more expensive and green power keeps getting cheaper. So as a result, as of today, with no investment made by the consumer, it's 30% cost savings, plus, it's a good thing.
You would say, for example, you set this up on-premise and off-site as well?
It's
all
off-premise.
of it is off-premise, or
yes.
There is some in the...
So we have about 14-15% of our business is on-premise, so which is, you could loosely call it rooftop solar for large industrial companies, but it's only about 15% of our aggregate volumes.
So the way it works is you will put in the investment, and then you will maintain it as well.
It's our investment, it's our plant. Okay. We have, on average, a 23-year contract. I mean, we have 1,600 contracts, so different tenures. Average is about 23 years. And we sell the energy so produced. So to a corporate customer, they don't have to make an investment. They, they've got an assured rate, which they know is cheaper.
Is negotiated, or that is usually, it comes up for renegotiation, the tariff rate is...
No, it's fixed for 23 years. So it's not open to renegotiation. So we have 0% of our sales on merchant basis. So we don't do anything on merchant. We do only long-term contracts. Okay. Very diversified portfolio because it's 500 plus clients and 1,600 plus contracts.
Okay. Just a quick question. I remember you telling me that 43% of your contracted capacity is for data centers and AI. And I was just Googling. There is a partnership between CleanMax and, say, a company like Google as well. Right? So tell us a bit about your AI data center pipeline. What does this 43% move up to?
So a big personal thanks from me to Sundar Pichai, who was in India last week, and in his interview mentioned about Google's partnership with CleanMax for energy. Great timing. Thank you. But 43% of our volumes is with data and AI, and this has exploded in growth. As of March 24, we were doing about, our contracted volumes with data and AI was 250 megawatt. It has risen nearly 10x to about 2,400 megawatt by October 25. So 1.5 years, 10x growth. And what we are seeing is that data and AI energy consumption requirements, both in India and all over the world, are just from a different planet almost.
How does it work? I'm assuming these data centers have to run non-stop with backups, etc., right?
Yeah.
Whereas solar, etc., will be dependent on...
So the way we work is we do not impact the reliability of the power consumer because we are not providing the wire into them. The wire into any consumer is provided by the power distribution company. We upload our electricity. Suppose for a plant in Maharashtra, we are uploading ours in, say, Nagpur or Sholapur, and the consumer may be in Pune or Mumbai. Right? So we upload in a grid somewhere and the consumer downloads from his existing grid connection. So we do not affect the reliability. But yes, for data centers, it is always a mix of wind and solar power. Solar gives you more daytime, wind gives you more evening and late night power output. And therefore, about 25% of our capacity is wind and 75% is solar.
What about big data centers? I'm assuming they would have sort of arrangements for baseload power, thermal, etc. And this is additional in that sense, or?
Every consumer is a consumer of the power distribution company, right? And they do pay fixed charges to be a consumer, and that's what you pay for having the ability to take power.
Okay.
So we affect on the variable charges front. So we are 30% cheaper on the variable charges on a fully landed like-to-like comparable basis. And for data center, typically we would be meeting 60 to 75% of their energy requirements. months.
Okay, and very quickly, BESS, battery energy storage system, you all would have that as well. When
We're beginning to integrate those into our power plants because as technologies evolve and storage becomes cheaper, it's becoming cost effective, for instance, to make solar power, store it in the day, and give it to people at peak when their pricing is also more. So in a nutshell, guys, the share of green in direct corporate procurement in 2019 was 4%. It's risen to 7.5% in 23, and it continues to grow because the value proposition to the customers is great. It's 30% plus cost savings, no investment for doing the right thing.
All right. Thanks a lot, Kuldeep, for coming down. Wishing you, the team, all the very best with regard to the IPO. And on listing, we'll push you a little bit more for future guidance. But thanks a lot for joining in.
Thank you.
Thank you, everyone. Cheers.
All right, let's just quickly take stock of the IT stocks. Last week, we had a big fall in IT names. And this morning, despite the green on the screen, the Nifty IT index is still down about 1/3 of a percentage point. So quick word what Jefferies has to say. They say despite the 16% fall in Nifty IT on a year-to-date basis, stocks still offer more downside than upside. They've downgraded Infosys, HCL Tech, Emphasis to a hold. They've downgraded an LTI, Mindtree, Hexaware, and a TCS to an underperform. So some of the target price and the way it's come down will come up for you on your screen. On TCS, the target price has been cut by 32%. On Infosys, the target price has been cut by 31%. On HCL Tech, it's cut by 26%. And despite that, Jeffrey says that the target price is lower than the current market price by 13% for TCS, 5% for Infosys, about a 14 and 19% respectively for TCS and Tech Mahindra. So even after cutting the target price by 25-30%, there is still some downside that Jeffrey sees. Sagility, Coforge, IKS remain their top picks because of higher earnings growth expectations. So only 3 buy ideas, and these are some of those BPO names in the healthcare space. And the key reason is they're saying that the IT stocks continue to trade at a premium to Nifty despite delivering slower earnings growth than the Nifty since FY17. And that chart will come up for you. They're saying from FY17 to FY28, the Nifty grew at 12%. IT index IT earnings was only up 9%. From FY22 to FY26, Nifty went up 10%, but the IT growth was only 6%. And yet the IT index trades at a premium, and that premium needs to get corrected. And plus they say that it trades at a 32% premium to Accenture, which perhaps makes no sense to Jefferies. So they see valuation derating and further downside from here on. Nagraj Shetty is now joining in from HDFC Securities on the show. Nagraj, thank you very much for joining in. Well, good start to the week. The Nifty is above 25,700. Do you think for the near term, the trade on the upside has played out, or do you see more momentum?
I think Nifty is stuck within a range of around 26,000 at the higher levels and 25,400 at the lower levels. Market rising geopolitical tensions, highly volatile market is showing some kind of a range moment. I think having bounced back from the lower range of around 25,400 levels, the market is expected to reach towards the upper range of around 25,900, 26,000 in the near term.
Stocks?
Yeah, I have 2 stocks from the long side. Even broader markets are showing some signs of upside momentum. First one is from PSU banking front. PSU banking as a sector has been in a tremendous move. And even the stock like a PNB has witnessed a sharp breakout recently after a consolidation movement. And overall chart pattern is indicating there is a possibility of certain more upside in the near term. Currently trading around 132.3. One can look to buy at this point of time. Immediate upside target would be around 140. One can place a stop loss at 128. Second one is from a realty front, that is Hemisphere Properties. This stock has been showing a larger consolidation pattern over the last couple of months. Currently faced the resistance around 200-day EMA, moved up above that level, sustaining above that level. Overall chart pattern is looking positive. Currently trading around 143.60, 144 levels. One can look to buy at this point of time. The immediate target would be around 152. One can place a stop loss at 138.
Okay, all right. We'll leave it there. Thank you very much for joining us and running us through those trading ideas. 150 odd points on the Nifty is what you have. So it's a decent looking screen all told. Manisha is here with commodities in focus. What's top of mind in just a bit. Stay tuned.
Welcome back. Let's talk commodities now. Manisha is joining in as always. Manisha, hi. What are you looking at?
Well, I'm looking at the safe haven buying that the precious metals seem to be indulging into. So you have the gold prices, which have gained up 1.5% in the Asian markets right now. We are trading at around $51.50 an ounce. This is a 3-week highs coming back in case of the gold prices. The profit-taking or correction clearly has been quite short-lived. In any case, $5,000 an ounce is where the gold prices have been meandering, and we've seen gains come back into this one. If you look at on-week basis, then we are seeing 4% of gains for gold. And on the yearly basis, 20% of gains is what gold has given you till time. Silver clearly surging in right now, 3.5% up in the markets therein. And we're looking at nearly 15% of gains in case of silver prices. And silver has outperformed gold yet again in this year with 22% of gains YTD till time there. Well, it has to do with the weak US data, whether it was the GDP numbers, inflation, jobs data. All of that has been quite supportive for the gold and silver prices. And then it all has been about the US president's statements over the weekend announcing raise in global tariffs from 10 to 15%. This is for the next 150 days. And this is under Section 122 of the US trade law, which allows just about that much. And that is exactly what the US president has done. Well, apart from that, it also is about those tariff agreements. There are reports on how Europe has halted confirmation of trade deal with US. The India-US negotiation at finalizing interim deal also seems to have been postponed. So some buying coming in because of that as well. And then it is about US and Iran. That is the major area where you have seen various asset classes continue to take cues from. So from where we stand right now, well, there are fears of potential US military strike on Iran. Both countries, even as they are headed for a negotiation, seem to be building their military presence on ground therein. US and Iran, in the meanwhile, are headed for a third round of negotiation in Geneva, and this is on 26th of Feb, which is a Thursday. Iran has said that it is ready to make concessions in nuclear program, but what Iran seems to be getting stuck on right now is it's asking for lifting of sanctions and understanding on its right to enrich uranium. So that is going to be the conversation when both the countries meet on 26th of Feb there. Having said that, it also is an interesting report that has come in from UBS. They have hiked 2026 price target for gold to $6,200 an ounce. We are just about $1,000 lower from where that target seems to be coming in from. But UBS says that they are expecting record demand for 2026. Remember, in 2025, the global demand for gold was a record 5,000 tons. Expectation is that you could be looking at that number exceeding. There is strong central bank buying. There is strong investment buying as well. The safe haven buying. All of that continues to support gold.
All right. Thanks very much, Manisha, for that. So, yeah, gold back above 5,100. Silver seeing a jump, and that's at about $87 or so. So, precious metals back in focus once again. Markets, by the way, not doing all that badly. 160 points up, 25,730. Advanced decline was one way in the morning as we started, but it's now closer. About 1,700 up and about 1,200 lower is the NSE overall advanced decline ratio. Still positive, but the gap's closed. IDFC is down 18% now, so at about, 68 odd rupees on IDFC, and 18% lower, yeah? 18% lower. AU Bank is down 6.5%. Low here was about 950. And that's the other one. UPL is down 12%. So these are the three news-related names all down and out. HAL is down 2.75%. Had a bit of a bump up lift from the lows recently. The low was about 3,900 and went up all the way to about 4,300 3 days back, but back around 4,000. Godfrey Phillips had a massive move last week. It's giving back some of it. It's down about 7%, Godfrey Phillips. There is Avanti Feed, which I think had a very good week, the last one, which it's giving back some. Coforge is down about 2.5%. It's kind of sinking to new lows. There is Gokuldas Exports, which is down 2%. So, the textile thing is now playing out. Textile 772 on Gokuldas. And I think Pearl Global, the management we spoke to, maybe we'll be able to put that stock up as well to see where Pearl Global is at right now. In the morning, it was flat to slightly higher. All right, time for a quick commercial break here. On the other side, Lata speaks with investing veteran Vetri Subramaniam, now CEO of UTR AMC, and of course, markets, tariffs, uncertainty, all of it. So that's a special conversation coming up.
Welcome back. We are sticking with markets because they're so compellingly important now. Most Asian markets, including Indian markets, have almost in a celebratory mode because of the attack on Trump's tariffs and the Supreme Court even questioning his authority to levy them. More broadly, I mean, not just the over the weekend impact, even more broadly, if you looked at 2025, both global growth and global equities have actually done well, despite the geopolitical challenges. Of course, India underperformed. But where does all this leave us here on? I'm joined by a veteran of the markets, Vetri Subramaniam. Now, in the last 25 days, he's Managing Director and CEO of UTI AMC. Good morning, Vetri. Many congratulations on the new appointment. Though I will have to say that I will make you wear your older hat of CIO every now and then because the markets are so compelling.
Good morning, Lata. Delighted to be here in this new avatar. But in some senses, yes, you can't take the fund manager out of me. But I'm not involved in fund management directly. That's the prerogative of the FMs now.
Okay. No, I take your point, but we will still want your thoughts. Actually, now, how are you looking at the Indian markets now? We did underperform a year of 2025 when actually many global markets and especially global economy has actually been doing well. Now, do you think we are on the cusp of something better? How did you read the Q3 earnings, etc.?
Right. So I would, sort of submit that actually after 3 very strong years of earnings growth, both 2025 and 26 in terms of earnings growth have been disappointing, just relative to our own past trajectory, as well as relative to the kind of expectations, investors had from the Indian economy in terms of the earnings growth that could be delivered. 2026 looks like it will end up with single-digit earnings growth at this point of time. The good news, Lata, going into 27 is that fiscal policy, as we all know, has turned extremely supportive, whether it was the GST cut, whether it was the income tax cut a year ago almost. And then on top of that, you also have a monetary policy which has turned quite supportive over the last year. Now, what does this imply for earnings growth? It's a very simple correlation. I think the likelihood of nominal GDP growth being in the double digits is much better this year. And that in general should make the environment much healthier for companies in terms of earnings growth. So I do think, growth will be better in 2027. But having said that, the market is not particularly cheap. So we'll still have to sort of navigate what I believe are the crosswinds, both from valuations as well as some of these other factors that dominate the news flow. And I'm sure we'll talk more about that during our conversation.
Absolutely. I'm coming to that as well. See, I agree with you that on the earnings front, this double-digit nominal GDP, and we will know more about it on February 27th when the new series of GDP is announced. But that is, of course, a tailwind. How are you looking at tariffs? All Asian markets are up today, including ours. Would you say that there is a general relief that the tariff syndrome, the ability to levy tariffs itself has been weakened by the US Supreme Court? So the worst is behind us on that front, at least?
I'm not sure we have that kind of clarity at this point of time. I think it's a chess game which is still deep in the midsection. So it's very hard to figure out what the next few moves will be. Obviously, it has been a signature policy of the current US administration, and they've been able to use this power under the IPA to great effect in terms of getting to, push countries around, being able to enter into, fast track negotiations with them. Now, this being struck down obviously makes it a little bit more difficult. But I would just say that, there are other routes available to them. I think they've already talked about this. So we are sort of stuck in the mid game over here. And I think the larger point, Lata, is that it's very easy for markets to sort of, either get excited or get disappointed in the very short term. But the larger element here is that for businessmen, you are completely out here in limbo because you don't have an agreement that gives you the visibility of taking large investment decisions about where and how you would like to manufacture and how you would like to serve global markets, including, of course, the US market. This is not particularly unique to India. I think this is a challenge which entrepreneurs and businessmen across the world are facing right now, that they don't have a sense of what does the playing field look like because all of it is continuously being renegotiated. And it's not good when entrepreneurs have so much lack of clarity. They tend to hold back on their investment decisions.
You know, Vetri, I heard this, paraphrasing your statement, argument, exactly like this a year ago. I mean, there was Chetana here. There were so many people telling us that, you know, the way in which everything we believed in terms of WTO has been uprooted and thrown. Remember last February, Liberation Day and all that. But actually, 25 turned out to be a very good growth year. So I'm just wondering whether this equation we made between uncertainty and investment didn't work out at least last year. So, I mean, we may be proved wrong and it could get worse, but it hasn't hurt so far. In fact, we have seen very good, GDP growth as well as earnings growth. Okay, let me come to...
I can just parse that in two ways, Lata. One is you didn't see the impact in the US because of the AI-related boom. So the fact that the old economy stopped doing stuff didn't show up in their data. And as far as India is concerned, anyway, exports is not the main lever of our growth. So it's only the marginal case that we are talking about. We are not talking about it halting the whole economy. I mean, this kind of thing would have a more dramatic impact, let's say in a Vietnam or a Malaysia or those kind of countries which have much higher trade, goods trade, and much higher trade dependency on the US. For India, it's a very limited factor.
I take your point entirely. In fact, there were some noises in the morning saying positively that because we know for 150 days it's going to be 15%, maybe there will be even, advance booking. And we may actually see a very good trade number for whatever it is. But the rupee is stronger this morning. And
Lata, but just to clarify, equities don't price themselves based on 150 days of earnings. They price themselves based on, 5, 10, 15 years of earnings. So, market being up 0.5% to me has nothing to do with the tariff.
Doesn't
it could
prove
be
anything.
up 0.5% irrespective of whether this whole tariff decision happened on Friday by the US Supreme Court or not.
I agree with you. I agree with you.
In the range of normal daily volatility.
Take your point. Okay, Vetri, let me therefore get back to earnings and valuations, which are more longer term. Where do the two meet for you? Where are earnings looking good and where the sectors are not yet priced to perfection?
Sure. So let me just parse that two ways, because we also talk to a lot of the global investors. We manage $3 billion of assets for global investors, predominantly in equity. And I think for them, the challenge remains that India's valuations relative to other markets, both EM and developed, is still at a premium, whereas the earnings growth numbers are still not showing the kind of momentum which they would expect to see in a market which is priced where India is. Now, having said that, the relative gap that Indian valuations had to other EMs has come off quite dramatically. So I must say, incrementally, people are, willing to at least sort of start engaging in discussions regarding India, but I'm yet to see it converting into flows. If you break that down into an Indian context, Lata, to me, one of the key things at this point of time is that if you really want the economy to start to fire a little bit more in terms of earnings, it comes back to animal spirits, and it comes back to what are the trends we are seeing in terms of credit growth. So when I see credit growth numbers coming into the low teens, I think that's a great thing, because look, in the short term, credit is fuel for the economy. And if you've got credit growth which can hold up in the low teens, relative to where nominal GDP growth might be, that to my mind is the most powerful fuel. And for that very reason, I still continue to believe that, banking and financial services is the direct play on a sector which will benefit, where your starting valuations remain reasonable, not as cheap as maybe they were a year and a half ago, but still very, very reasonable relative to their double-digit growth prospects and, reasonably healthy ROEs across the board.
You've handed me a question on a platter. Now, in banking itself, one of the themes that has played out over the last 6 months, maybe even 1 year, is public sector banks have done much better than private sector banks, both in terms of P&L and in terms of performance in the stock market. Valuation gap has narrowed. Does that continue?
I prefer to treat that as stock specific. And, again, as I said, I don't do fund management anymore. But my own recommendation to anybody would be is select the stock on its merits. We have seen some of the public sector banks demonstrate very strong metrics over the last few years. So I wouldn't use the ownership lens to determine where to position portfolios. You could do that based on the individual characteristics of those institutions, both in terms of the strength of the balance sheet, the extent to which their non-performing loans have been sorted out, and their ability to grow on a self-sustained basis without requiring equity infusion. So I think you see those characteristics both in the private and public sector space, and there's no reason to distinguish just based on ownership.
No, I can take this battle for long, but we are out of time. Can you just, give us the best top three in terms of the within the BFSI space itself? Private banks, I won't give you ownership. Banks, NBFCs, insurance companies, and other market infrastructure companies. How would you grade them? Which would be your best?
Sure. The way I look at this is again from a valuation template. If you look at it from that point of view, I think banks and NBFCs pretty much come over there on top. And maybe after that, you would also get some of the insurers, which remember have done nothing for a while. Capital markets is actually a slightly trickier place because I think all of them are trading on the back of very strong tailwinds, including the market intermediary businesses. So I think over there, growth has been good. Many of them are annuity type businesses, some of them are monopoly type businesses, but at the same time, starting valuations are not particularly exciting.
Okay, yeah, and then there's a big one which will also list, so there'll be competition for that as well. Final question, since we are talking about market intermediaries, you yourself now are the CEO of one such institution. The issue was in the Q3 numbers with that big one-off payment, 109 crore payout. Is that overhang over? Or will that persist? Because pensioners everywhere are up in arms for a whole host of reasons.
Yeah, whatever was related to our VRS and some of the other, one-time changes that we had to do have all been accounted for in the past 2 quarters. So there is no more, one-offs that will pass through the accounts. Remember, we also had to provision for the labor codes, which, almost everybody in the corporate sector had to do. So I think all of that is behind us. And, we think the business is in a good place. It's a strong team, technology, processes, and we are quite excited about being able to tap into the growth opportunity as more and more Indians look to sort of plan for their financial future. As we say, our role as an institution for 60 plus years has to be to enable Indians to have a better financial life. And that's the path down which we will continue to move.
Okay. There's so much I haven't asked you in special investment vehicles, funds that are being launched, AIF, challenges from people like Grow. There's too much more to discuss with you. I'll take a rain check from you for another interview very soon. Thank you very much for joining us, Vitri.
Thank you so much, Lata.
Okay, that's the word coming in from one market veteran, somewhat positive that the earnings cycle is looking better. Wrap up on Bazaar on that note. Chartbusters coming.